Now that we know the basics of what a candle indicates, let us discuss some of the select patterns that are useful in interpreting the likely price movements. We will start off with bullish patterns. Hammer. The first one we take up is the hammer candlestick pattern. The hammer candlestick pattern is formed with a small body of a candle with a long lower wick. It is not as heavy as Thor's hammer, and everybody can pick it up and learn to use it to predict price movements. It is usually formed at the bottom of a downward trend when prices are falling. A hammer pattern indicates that although there were selling pressures during the day, ultimately a strong buying pressure will drive the price back up. The color of the body can vary from green hammers indicate a stronger bull market than red hammers. Inverted hammer. Inverted hammer is another interesting bullish pattern. The major difference between hammer and inverted hammer is that the upper wick is long, while the lower wick is short in an inverted hammer. This indicates a buying pressure, followed by a selling pressure that was not strong enough to drive the market price down. The inverted hammer indicates that buyers may regain control of the bullish market. Bullish engulfing. Both the hammer and inverted hammer patterns are formed by single candles, but patterns can also be formed by two candles together. The bullish engulfing pattern is formed when the first candle is a red short body that is completely engulfed by a larger green candle. This shows that the buyers are participating in greater numbers and pushing up the prices. Piercing line. The piercing line is another bullish pattern where a long red candle is followed by a long green candle, where the closing price of the green candle is above the halfway mark of the red candle. Morning star. Morning star candlestick pattern is when a short body candle is between a red long candle and a long green candle. The candle in between acts as a bridge in changing the momentum from bearish to bullish. Three white soldiers. Three white soldiers pattern occur when three consecutive long green candles with small wicks open and close progressively higher than the previous day. This is a strong bullish signal that usually occurs after a downtrend. This indicates buying pressure and bullishness. Having discussed 6 of the bullish candlestick patterns, let us analyze some bearish candlestick patterns. Usually, after an uptrend, candlestick patterns can form to indicate bearishness. Hanging man. The hanging man is the first bearish candlestick pattern that we shall be discussing. The candle has a long lower wick indicating that bears were trying to sell but bulls were trying to increase the price higher but were meeting stiff resistance. This indicates that the markets are going to decline after the uptrend. Shooting star. The shooting star has a similar shape as an inverted hammer. The only difference is that shooting star is formed at the end of an uptrend. Shooting star has a small body but a long upper wick indicating that the bulls were trying to push the prices higher but were unsuccessful due to heavy resistance. Next, we shall be discussing the bearish engulfing pattern. This is the exact opposite of the bullish engulfing pattern. There is a large red candle that tries to engulf the previous time period's green candle. When a short candle is in between a long green candle and a long red candle, an evening star pattern is formed. The candle in between acts as a bridge between the bullish phase transforming to the bearish phase. Another bearish pattern is the 3 black crows candlestick pattern. It consists of 3 red candles with successive days of lower highs and lower lows, thereby indicating a trend reversal and bearishness. The dark cloud cover candlestick pattern has a large red candle that closes below the halfway mark of the previous day's green candle. The candle on the third day closing below the halfway mark confirms the bearish signal. Now that we have discussed bullish and bearish candlestick patterns, let us further discuss a few continuation patterns. Now, there are also some patterns that indicate that prices are range-bound or a continuation pattern. There are a few candlestick patterns that neither indicate a bullish or bearish pattern, but indicate indecision or a neutral price movement. A doji pattern occurs when the open and close are almost at the same price point. The body of the candle is very narrow. The candlestick resembles a cross or a plus sign. This pattern indicates that the market is confused or does not know which direction it is likely to be headed. So it is more of a neutral pattern. Similarly, a spinning top candlestick pattern has a smaller body but have wicks of almost equal length. The pattern once again indicates an indecisiveness in the market. We have discussed some of the important bullish and bearish candlestick chart patterns as well as a few of the continuation patterns. Now, an important aspect to know is that these patterns and charts cannot be read standalone. The trading volumes during the time period also impact the chart patterns. So, one should always factor in trading volumes to really interpret a candlestick chart. If prices are increasing with several lots of green candles, but the trading volume is decreasing, then this is an indicator that the market may be preparing to reverse the trend. Similarly, if there are lots of red candles but the trading volume is decreasing, then this is an indicator of a trend reversal from a bearish momentum. Charts show price patterns, resistance and support for price movements with trend lines. For more advanced study, some indicators that can be studied are MACD, moving average, RSI and Bollinger Bands. Technical charts can also clearly provide information on the support, that is the lower limit of the coin price, and resistance levels, the upper limit of the coin price. Along with the trend lines, they indicate a likely direction for the market. We have provided you with all the basic tools that you must require to commence your study of technical charts to gauge the sentiment of the market and the movement expected. We shall be discussing in greater detail during our more advanced courses on the various technical analysis indicators such as the moving averages that assist in smoothing out the historic price trends, moving average conversions, diversions or MACD that provides signal for a trending market. This should be analyzed along with the average directional index or ADX to determine if the market is trending or range bound. Stochastics for a range bound market. Bollinger Bands that depend on the standard deviation of the historical prices to indicate a likely boundary for the prices to adopt, and several other interesting indicators such as the Ichimoku cloud, parabolic SAR and several others indicators. So stay tuned for the advanced course sessions on technical analysis. Please note, each cryptocurrency requires its own study and blend, a combination of fundamentals and technical analysis to ascertain future price movements. It is up to the trader to learn more towards fundamental or more towards technical analysis. There is no one-size-fits-all strategy. Technical analysis is used more for short-term investing and fundamental analysis for long-term analysis. A study of both is important.